Hello class, welcome to my video. This video is for your chapter 8, using and understanding financial statement for a company. And this chapter is not something new to you because you have learned this in your principles of finance. So what we can learn in this chapter, upon completion of this chapter, candidates should be able to calculate the key financial ratio by using the financial statement information. Comments on the performance of a business with reference of key financial ratio, and describe the limitation of ratio analysis. So let's start. Ratio analysis. What is ratio analysis? Ratio analysis is the calculation and interpretation of financial ratio in order to draw conclusion or raise question about the financial position and performance of a company. Ratio analysis shall not be used in isolation. It shall be used to compare with either past performance, expected performance, or competitor performance. Who are the potential users of ratio analysis? Management, current and prospective investor, financial analysis, or auditor for the auditing purpose. We have 4 types of ratio. The first one is profitability and efficiency. Next one is liquidity and working capital control. Next one, gearing and financial risk. And last one, investment performance. What are the limitations when we use ratio analysis? Inflation may affect the financial result over the time, so it may not be able to give a fair comparison. The different accounting policy use or change in the accounting policy may get some effect in the comparison. And last one, ratio analysis merely focus on the financial and monetary information, but they ignore some of the information that will have a great impact on the success of a business, such as customer loyalty and employees loyalty. So in the next page, you can see that these are the ratio, and this is not something new to you. You have learned this in your principles of finance. So basically in FA2, I will just briefly expand the ratio as give you some refresh on the ratio. So let's start the first one, profitability and efficiency. In your profitability and efficiency ratio, you are able to tell the financial performance of a business. Profitability tells how much of profit that a company can get in relation to sales. Efficiency indicate how good is the company to utilize its resources. So what are the ratios under profitability and efficiency? The first one, gross profit margin. Formula, we use gross profit divided by revenue times 100%. So our answer will be present in percentage. So what is GPM, gross profit margin? Basically, how much you can earn from the sale of the product of the company. Next, net profit margin. Net profit margin is based on the net profit of the company divided by revenue times 100%. Your answer will be in a percentage as well. So what is net profit margin? How many percent that you can earn after you deducting all the expenses, including your interest and tax. This is net profit margin. Next, return on capital employed. What is return on capital employed? So this is measure how good is the management in utilizing the capital employed to generate profit. So what is capital employed? Capital employed can be defined as the amount that a company investing in generate the profit. So we have to take a look how to get the capital employed for the company. You have 2 methods to get the capital employed. First, you use total asset minus your current liability, or you use your non-current liability plus total equity. Both formula will give you the same answer for the capital employed. And the formula for ROCE, we use profit before tax profit before interest and tax, PBIT. Another name for this PBIT is called operating profit. So we use operating profit divided by capital employed and multiplied by 100%. So we get the answer in percentage. So next, return on equity. Return on equity formula, we use net profit divided by total equity times 100%. So what we can understand from this return on equity, how much of the profit that we can earn from the equity that invested by the shareholder. And the last one in our profitability and efficiency will be our asset turnover. So asset turnover formula, we use revenue divided by total asset. Our answer will be a times. So what we can understand from asset turnover, how many revenue that you can generate from the use of the existing asset. So this is the meaning for asset turnover. Next, the next category of your financial ratio will be liquidity and working capital control. Liquidity is the ability of company to meet its short-term obligation. On the other hand, working capital control tries to assess how the business manage their cash flow from the business operation. So the first one, current ratio. Current ratio formula, we use the total asset divided by the total current liability. Our answer will be shown in a times. But for quick ratio, there are some small difference as compared to current ratio. For quick ratio, we have to minus inventory in our formula in order to get the answer. The answer in the times as well. So both ratio discuss whether the company can meet its short-term obligation. As a benchmark, normally the company current asset should higher than the current liability. The company current asset should more than the current liability. So the suggested or the benchmark for current ratio, benchmark means that the ideal ratio for current ratio should be 2. And for the quick ratio, the benchmark should be 1. This is just a benchmark. Depends on the industry, the benchmark may be different. I just give you a suggestion. It means that in a normal company, the current asset of the company should be 2 times more than the current liability. But for quick ratio, we have to minus inventory. Why we need to minus inventory? Because inventory take longer time to convert into cash. For example, the inventory, you have to sell it to your trade receivables. And trade receivables, you give them a credit term, you may take another 2 months in order to convert into cash. So here you need a 2 transformation, so you only can get the amount in cash. So it takes too long of time to convert your inventory into cash. So in the quick ratio, or we call assist-take ratio, we ignore inventory because inventory is taking too long of time in the conversion. Next, the next ratio is receivable collection days. So receivables collection day formula, we use receivables and we only divided in credit revenue. What is credit revenue? It means that you sell to your customer without immediate payment. If you collect the money immediate from them, then this is called cash revenue or called cash sales. But in receivables collection date, we only consider credit revenue. Why? Because only when we have a credit sales, then we have receivables. If we cash sales to our customer, then we will not have any receivables. But if in the question, the examiner is silent on what is the amount of credit sales, then you can recognize the full revenue as the credit revenue. So formula, receivables divided by credit revenue times 365 days. So what we can understand from the receivable collection dates, it means that how long for your customer to pay you the money from the day you sell their products. For example, if your receivables collection days are 30, it means that when you sell the product to your customer only repay you in 30 days later. So here, receivable collection dates, smaller is better. Smaller in the receivable collection date is better because it means that your customer pay you fast, so that the risk of bad debts will become lesser and the company has more cash flow for operating purposes. Next, The next ratio is payable payment days. Similar to your receivable payments, payable we also have this. So formula, we use the payables divided by the credit purchase. Remember, credit purchase times 365 days, and our answer will be a number of days. In the absence of credit purchase, you can use cost of goods sold. In the absence of credit purchase in your question, you can use cost of goods sold. So what is the meaning for your payables payment date? It means that from the day you purchase the stock from your supplier, how long you make the repayment to them. So there is one question. For payable payments date, longer better or shorter better? Longer in the payable payments day better or shorter better? The answer is there is no a fixed answer for this. If your payable payment date is too long, it means that you may have financial problem. You may not be able to pay your supplier on time. So if you have insufficient cash to pay to your supplier may not be happy, so they may cut your supply. However, if you pay your supplier too fast, it means that your payable payment date is too short. You will have a problem. You may not have enough cash for your daily operation. So the payable payments date you have to control nicely. Normally, we base on how many credit terms that offered by our supplier. We just follow that for payment purpose. Next one, inventory turnover days. Here we discuss how long the company sell the product from the day of purchase. What is the formula? We use the inventory divided by the cost of goods sold and times 365 days. So the answer will be a number of days. So in our inventory turnover days, normally shorter is better. If you have a shorter inventory turnover days, it means that you can sell your product very fast. When you buy from your supplier, you can use a short period to sell it to your customer. It means that you have a good business. So shorter in the inventory turnover days will be better for the company. Next ratio is about your gearing and financial risk. So in the gearing and financial risk, we measure the extent to which a company is financed by borrowing as opposed to its capital. How much of the money, or what is the percentage of the money that the company borrow from external? So first ratio, interest coverage. Interest coverage formula is we use the profit before interest and tax, PBIT, or we can call operating profit divided by the interest expenses. Our answer will be in a times. Here, it means that if the company not doing business in the future, how many times that the company can pay the interest expenses based on the current profit. So you know, if you borrow the money from bank, they will charge you interest. And when they charge you interest, this will become interest expenses for the company. And interest expenses, they are regardless of the company performance. Let's say the company earn more profit this year, you are not required to pay more interest to the bank. But if your business is doing bad business, you are not earning money this year, you still need to pay interest expenses. So here, we discuss whether the company is having a strong profit to cover the interest expense. So here, we will discuss the higher of the interest coverage is better. It means that the company is more safe. Imagine if you cannot pay the interest to the bank, what will they do? They may ask for immediate collection from your borrowing. So this is quite risky for the company if you have a too low interest coverage. Next, the next ratio is debt to equity. So here we compare what is the percentage of debts over the company equity. The formula, we use the non-current liability divided by the total equity and multiply by 100%. Our answer is a percentage. Next, the next ratio is very similar to debt to equity, but we extend the basic extend up to capital employed, debt to capital employed ratio. So we use the non-current liability divided by the capital employed and multiply by the 100%. So we get our answer in a percentage. Next, the next ratio is regarding the investment performance. Investment ratio measures the potential profit for the investment in a company. So this one is more related to the investor. This one is more related to the investor. There are two types of gain available to investor, namely capital gain and dividend. Capital gain refer to the increase in the market share price. Dividend refer to the profit distributed by the company to its shareholder. So normally, if you invest in the share market in Malaysia, you cannot buy the private company share. You must buy listed company share. So when you purchase the listed company share, you may have two types earning. The first earning will be the capital gain. It means that you buy the share at a low price and you sell at a high price. The difference will be your profit. Another types of profit is called dividend. Dividend is when the company is earning good profit, they will give you dividend. Then that will be the income for the investor. So what are the ratios under investment performance? The first one, earning per share. Earning per share discuss what are the profit available to each share of the company. Formula, we use the net profit divided by the number of share, and we can get the value per share. So normally we will get our answer in cent. How many cent of the company earning per share? Next ratio, price earning ratio. Price earning ratio is regarding the valuation of the company. PE ratio is regarding the valuation of the company. So we will use the PE ratio in this formula. We use the market share price divided by the earning per share, so we get the answer in a times. Price earning ratio, we use the market share price divided by the earning per share, so we get the numbers of times. So basically this ratio indicate how long you can cover the amount that you invest the company. So the times here refer to the number of year. But you have to be careful. There are two different perspectives when you have a high PE or a low PE. So let's see what are the things to take care when we using price earning ratio for investment decision. In essence, the price earning ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earning. This is why PE is sometimes referred to as the multiple, because it shows how much the investor are willing to pay per dollar of the earning. In a general, a high PE ratio suggests that the investor are expecting high earnings growth in the future compared to other company with a low PE. However, a low PE may indicate that the company are currently undervalued or the company is having a financial difficulty. So for PE ratio, you have to determine your own investment preference, because normally the company with high PE may indicate that the company is having a higher risk. So you have to take note when you're using PE ratio for the share selection. Next, dividend cover. Dividend cover discuss how much of the profit can be used for dividend payment. So we use net profit divided by the dividend paid, so we get the numbers of times. Next, dividend year. Dividend year discuss how much you can earn from the as a dividend. What is the percentage of the dividend that you earn from the money that you invest in the company? The formula, we use dividend per share divided by the market share price and multiply by 100%. So you get a percentage. And that's all for the explanation of your financial ratio. In the next video, we are going to do classroom exercise 8.1 together. I will see you in the next video. Thanks for watching. If you have any question, you can leave me a message or ask in the LMS. Thank you.